Well, your predilection for typing is causing me to be a bit miserly when it comes to these Friday Q&A shows. I was really enjoying the bountiful harvests that we had over the past couple of months, where I could do 5 or maybe even 6 question episodes. But today, no, I can't, because most of our questions, most of them, the vast majority, are now coming in typed. It says a lot about where we are right now. We are really attached to our keyboards. I mean, think about it. We tend not to like to make phone calls. We're getting out of speaking practice. So I'm trying to help you get back in practice. Go to talkingrealmoney.com, hit the button that says contact us, and then speak your question. Your phone has a mic. I know your phone has a mic, and the quality is probably pretty good. Most of your computers have a mic, and many of you even have a pretty good mic hooked to your computer. And so if you speak the questions, then they get placed in the Friday Q&A podcast. If you type them, who knows where they're going to land. We're going to try and answer them somewhere, but they'll land all over the place. So go to talkingrealmoney.com, send me your questions, because I have to limit this week's episode to a mere 4 like last week, because that only leaves me 1 left for next week, which would be the shortest Q&A episode in history. Unless, of course, I have CathGPT read some of those typed ones, which I might be forced to do. I don't know. Anyway, we do have questions, and I'm grateful for those. Thank you so much. Let's get to the first one.
Hi, Tom and Dom. This is Ovais from Southern California. I have a question regarding a tool or some advice you can provide me regarding how do I make a decision on my work pension. If I retire at 65, my pension will be about 1.5 to 1.6 million if I take a lump sum, or I can get between 14 and 15,000 a month for second to die annuity from them, where both it will be available for both my wife and I at 100%. As long as we live, we'll get that. And just to give you some context, I'll have some additional money from my 401k, around between 4 to 5 million at that point, in a traditional IRA mostly, a very little in Roth. So with those things in mind, what would be the best way that I could make a decision whether to take a lump sum at retirement or to take the annuity? Any suggestions you can make, any advice you can give, I would appreciate that.
Well, this is a really attractive annuity. If the numbers you're giving me are accurate, this is a really attractive annuity. Most of these questions sit squarely at the intersection of math and emotions, where there's an emotional side and there's a math side. This one is, wow. This one is just barreled right through the need to even consider the emotions. If these numbers are right, because let's say you invested $1.5 million at 7% per year, which is probably a reasonable-ish balanced portfolio. That money's going to run out in less than 15 years, paying $14,000 a month. Now, when you give a lump sum like that to an insurance company or whomever to pay out a pension, you lose the use of that money. But in this case, that money's not going to do it appears to me, not nearly as much for you. And here's the other part of this that brings us back into that emotion money intersection, emotion math intersection, and that is the fact that you've got $5 million. You're going to have about $5 million in assets that can grow and be used for flexible purposes. So you got 14 or 15,000 a month plus Social Security, which puts you probably at $250,000 a year in income. That's for sure. And then you got the kicker of being able to draw an income off the other to live at a higher standard of living or do things that are possibly fun and extravagant. So in your case, and this is everything when it comes to money needs to be individualized. It really does. And that's why the psychology of it becomes so important. But in your case, I'd be really tempted. You've got everything going for you. And to have that security of $14,000 to $15,000 a month, I'd be really tempted to take that pension. I really would, not the lump sum. Thanks so much for your question. Remember, you can talk your question at talkingrealmoney.com. And also, if you like to talk questions and have a conversation, call us on Saturdays at 855-935-TALK, starting at 3 p.m. Eastern when we do a radio show. You can also type the questions if you want at talkingrealmoney.com. Now, the next one.
Hey, Tom and Don, this is Jason. Think about taking a job in a union which has a pension. I have a 401k through my current employer with Fidelity. I also have an IRA through Fidelity. I'm not sure if I should leave my 401k through my employer's or if I should move it to my IRA.
Well, that's the first question. Jason has two questions. This one it's not going to matter a whole heck of a lot. I mean, it's kind of nice to consolidate them because for rebalancing purposes and just plain old management, it's easier to have them in just one account. But is it a lot easier? I don't know. For me, it would come down to what are my choices in the employer plan versus the IRA. If I have the same choices, then it makes it a much harder decision. If you have better choices in your IRA, it makes it a much easier decision. Either way, I'm going to lean more towards going to the IRA than I am keeping it in the 401k. I know there's the argument about the protection of assets from torts in a 401k. But I don't think that's enough of an argument. I think the ease of use is the one that's going to sway me the most. Now let's go to your next question.
My second question is, since the union has a pension, should I not put as much into my retirement or should I find other sources since the IRA is so low? I think it's $7,000 a year. Thanks. Bye.
I mean, I would do the $7,000 a year if you're eligible. Yeah, I would continue to do that if you can afford it. I'm in favor of saving as much as you're able for retirement so that if you get hit with some surprises, some expensive surprises, you've got the assets to meet other needs above and beyond your immediate income needs that your pension and Social Security might, probably not, but might meet. So I would keep saving and investing, but this is where it comes down to having a plan. You're now to the point in life where you really need to start thinking about retirement income planning now that you might have a pension and these other assets, and start to get a rough idea of what your costs of living might be in retirement, and then you can do some calculations and determine how much you need or you might need to provide for that, plus a lot or a little extra, depending on what you think your future needs might be. So it's time for a plan, but yeah, save as much as you can. Thanks, Jason. Now, yeah, I know it's going to be a short episode. I'm sorry. Here's the last question.
To start off, I reprimanded, then applauded you and Tom for getting away from the basis points jargon you used a lot in the past. However, it feels like it's time to refresh your memory on using too many industry terms because it seems like you're both slipping with regard to jargon, especially your love of the term basis points. If your audience was other planners, no big deal, but it isn't. It's just us regulars trying to figure all this out, and the jargon makes it seem more complicated and gets in the way of the actual message.
All right, before we go on to the rest of your call, I want to address the basis point thing because you've raised this before, and there's a reason. I mean, okay, yeah, basis points, it's definitely jargon. But the other options stink. I mean, really, think about it. I can say 3 basis points on, a Vanguard ETF. It only costs 3 basis points. Or The only other, well, there are two other options. The other option that we use occasionally, maybe a lot, I try to throw it in almost every time if I think about it, is 3/100ths of 1%. Which is more succinct? 3 basis points or 3/100ths of 1%? Basis points is just a word that people need to learn. It's a term that everybody should probably learn. What is a basis point? And, it's like when you talk about julienning a carrot. Well, what's julienning a carrot? It's thin slicing it. It's easier because you can see it in your head once you know it. Or the term altitude. Well, when it's actually how high you are above sea level, which is easier, altitude or how high above sea level am I in feet? It's just what we use. And we do try, I know I do try, when I use basis points in an episode, at least once during the episode, generally more, to explain what that is. 3/100ths of 1% or 0.003%. But 0.003% really, where is it? Wait, 0.03%. That's what I meant. Saying that confuses people even more because now they got to go back to high school and go, what does that mean in a fraction? I don't remember. So I don't see that changing. I really don't. But thanks for the comment. And now to your real reason for calling.
Let me start off by saying I agree with you about cryptocurrency. I see no purpose other than making illegal payments, paying to get files back after a ransomware attack, and speculating on the future value of the specific cryptocurrency. Maybe the one possible benefit might be keeping less than democratic governments from controlling all of my money. As you said, it has no intrinsic value, and I'm not a cryptocurrency advocate, just the opposite. However,
and I knew there'd be a however,
in the discussions you've had about cryptocurrency, something always came to mind when thinking about cryptocurrency versus stocks. I see some important similarities. In both cases, what you have is on paper and not real, meaning not tangible like cash or even a credit card. With both, I have to convert them into real money in order to get the benefit. I can't buy a bag of potato chips with cryptocurrency or a stock. With stocks, I have an electronic record of ownership, but that's essentially the same with cryptocurrency. While there are likely tangible assets or services associated with an actual company, my personal ownership in the company is nothing more than air, like cryptocurrency, with a very slight possibility of maybe recovering some of my investment if the company is liquidated. So both are technically speculative. I personally feel that cryptocurrency is much more speculative, but that doesn't dismiss the fact that owning stocks is, as well, to some extent. Seems to me that owning cryptocurrency or a number of volatile penny stocks is basically the same. I'd be very interested in any thoughts you might have about this.
Okay, I see where you're coming from. And the penny stock comparison at the end is closer to where I think you have a reasonable argument or a reasonable concept. But even again, penny stocks probably, or may, not probably, but in some cases may have some tangible business purpose, which puts them slightly above crypto on the scale of speculation, slightly above. Bigger company stocks, I believe, on the speculative scale are much higher because at least there's an asset behind them and not just the hope that it'll be worth more in the future or that it will be worth anything in the future. There are hard assets behind most decent stocks. So that changes the scaling dramatically. So they're less risky. However, I get it. Individual stocks are still speculative. We say that all the time. We don't want any of our listeners buying, even holding, but certainly not trading individual stocks. It is high risk. As high risk as crypto? Not even close. Not even in the same universe, but risky nonetheless. Speculative, sure, because any company can drop to very little and maybe no value. Any individual company can do that. However, when you own them all, and this is what we believe. When you own them all, you no longer own a bunch of individual stocks. I mean, you do. But the bigger picture is you own the human economy, the value of all of the goods and services and assets that every publicly traded business on planet Earth has. And those assets and that productivity has proven over hundreds, if not thousands of years, to have been a pretty darned lucrative investment. Investment, not speculation. If at any time in history that we can track, you bought the entire economy of the world, you would have made money if you waited long enough. Period. You would have. You can't find any historical period. There was a professor, a PhD in Scotland, who studied these numbers, and he actually went back 2,000 years and found that the global economy has constantly grown despite individual market setbacks, certainly individual country setbacks or industry setbacks. But overall, when you factor in all of the economies around the world, which was very difficult to do through the historical record, you find that the global economy has always eventually made investors money. And that's where what we suggest differs from what the point you're making, and that is that stocks are similar to cryptocurrency. An individual stock, yeah, it's high risk. I don't think it's anywhere near as high, just generally speaking. But, I mean, I'd rather own gold than crypto. And I don't like gold as an investment. I think it's a pure speculation. But at least it's an asset that has value and purpose. It could be used for something, to make things out of it. It's a pretty good conductor, for example. Anyway, thank you for all your thoughts, your big, deep thoughts, and thank you all for the questions, even though there were only 4. And if you want to ask a question of me, please go to talkingrealmoney.com. Hit the Contact Us button and click the mic in the lower left corner and record it through your computer or your phone. Okay? You can also type a question in if you want. Those go to Tom, and then he doles them out. Or Saturday, we do a radio show in Seattle that ends up being part of our podcast each week. And you can call us and actually converse with us then. That's every Saturday at 3 Eastern, not 3 a.m., 3 p.m. And the phone number is 855-935-TALK. That's 855-935-8255. And thanks for listening and participating and telling people about the program. Oh, and by the way, if you'd like one of our, we are Tom and I are partners in an investment advisory firm that we used to own, and then we merged with another one. And it has really good advisors who really think similarly to us. Nobody thinks identically, but very similarly. And a lot of them want to help anybody who wants help. Anybody. Whether you're likely to be a client or not, we don't care. We want to make sure everybody gets at least some guidance if they need it and ask for it. That's why if you go to talkingrealmoney.com and click the button that says Meet an Advisor, you can set up an appointment to meet with one of our advisors for up to an hour. Don't go too long. They're doing this for nothing. It's pro bono. And they're literally doing it for nothing, and you will not get any kind of full court, high pressure sales pitch. Okay? So go to talkingrealmoney.com and remember to tell friends, many of them, about the podcast. And we'll be here. If people keep listening, we're going to be here for a while, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.